So why do 97% of retail investors consistently fall into the trap of buying at the absolute peak of a trend, only to sell on the inevitable dip?
Right.
It's not some secret cabal of sophisticated traders. It's not even a fundamental lack of, financial skill.
No, not at all.
It turns out it's a built-in emotional system. It's called regret aversion. And this intense pressure of FOMO, fear of missing out, that is being systematically monetized against your portfolio.
And that psychological weakness is basically the engine of every single speculative bubble.
And that engine, fueled by pure emotion, is driving some just historic valuations in the current technological revolution.
Absolutely. And so today, we are moving beyond the noise and executing a deep dive on three massive intersecting topics.
Okay.
First, we're decoding the psychology that systematically sabotages investor returns, and we're really focusing on the neurological basis of why we just cannot cut our losses.
Okay, so the brain science.
Yeah.
Then what?
Then second, we are exploring whether scientific research patterns, the very wellspring of this whole AI boom, can actually predict the next financial collapse. And we're using some groundbreaking machine learning models applied to the dot-com era.
And the third piece.
And third, we confront the fundamental crisis facing traditional valuation models, which, are completely obsolete in an economy driven by intangible assets.
Our mission today is pretty simple.
Yeah.
We want to uncover the surprising, actionable science behind these market crashes and the, frankly, revolutionary shifts in how value is created and measured.
Yeah.
We're going to give you the concrete steps to fight back against your own brain in the markets, because just knowing the trap exists is the first step to avoiding it.
That's right.
And if you want more of this kind of high-level analysis and disciplined financial guidance that cuts through the exact emotional cycles we're about to unpack, you should definitely subscribe to Money Mindset right now.
We are moving way beyond the hype to the surprisingly systematic failures in human behavior and even corporate accounting.
Okay, let's unpack this. Let's start with the hard numbers on this emotional disaster. We've all heard this statistic, right? Retail investors consistently underperform the market.
Mm-hmm.
But the scale of this failure is, I think, routinely underestimated. And the reason for it is profound. It's not just that individuals make isolated mistakes.
No, the failure is truly systemic. It's a function of predictable, quantifiable human behavior. That's the core finding.
So when researchers look at data across all these different markets, equities, futures, Forex, what do they find?
The results are just brutal. Studies of millions and millions of trades confirm that failure is the norm, it's not the exception. Only about 10% of retail investors actually manage to consistently make a profit.
Only 10%.
Maybe 20% break even over time, but a staggering 70%. They incur consistent, repeatable losses.
Wow.
But what's really critical here is the interpretation of that loss. Researchers have concluded that this consistent underperformance, these losses, are essentially the monetization of failures in managing regret emotions.
That framing is just chilling. The monetization of emotional failure.
It is.
Someone, somewhere, is profiting directly from your inability to manage fear and regret. And this leads us right to the core behavioral finding. If you ask an investor, do you buy high and sell low, they'll almost universally deny it.
Of course, everyone thinks they're above the herd.
Right.
But the data from these massive microsurveys of active traders, it reveals an astonishing ubiquity of the classic FOMO cycle. We're talking about a near universal human experience in the market.
How universal?
A detailed survey of 773 active traders showed that 96.99%, which is statistically everyone admitted to having experienced the complete full-loop FOMO cycle.
And that cycle is defined as?
It's defined by 4 distinct phases. Observe, hesitate, missed out, chase high.
Think about that number, almost 97%. That's near 100% confirmation, and it proves empirically that buying high and selling low is not some rare personality defect or just a matter of poor skill.
No, it is an inevitable, predictable human response when you are placed in a volatile, rapidly moving financial market and you lack any external systematic discipline to override your primal emotional circuitry.
And the engine driving this whole system, from the hesitation all the way to chasing the peak, is something called regret aversion.
That's the one.
So let's define that precisely in the context of behavioral economics. And it's a bit more complicated than just feeling bad after you make a mistake.
It is. Regret is specifically a negative emotion that arises from counterfactual thinking.
Counterfactual thinking.
Yeah.
So thinking about what could have been.
Exactly. It's that painful realization that if you had chosen a different path, a path you could have taken, the outcome would have been better. So investors spend all their cognitive energy trying to minimize what they anticipate feeling.
They don't want to look back and say, I shouldn't have done that.
Precisely.
What's truly fascinating to me is how the sources reveal this critical time asymmetry and how this regret plays out. The fear of one type of regret dominates at the beginning of a trend.
And the fear of a totally different type of regret dominates at the end. It's a switch.
Okay, so walk us through that. Let's look at the early trend, what the researchers call the latent period. This is the initial low-risk stage.
Right. So the price is still low, the risk is minimal, but the dominant fear investors feel is the error of commission.
The fear of doing wrong.
The fear of doing wrong, like buying a stock only for the market to immediately punish you and you watch the price drop 10%, that is acute, immediate pain.
And prospect theory gives us the neurological reason for why that pain is so paralyzing, right?
Yes. Loss aversion. It's a central pillar of prospect theory and basically states that our psychological sensitivity to a potential loss is about 2.25 times greater than our sensitivity to a potential gain of the same size.
So that potential 10% drop hurts more than twice as much as the thrill of a 10% gain feels good.
Exactly. So to avoid this immediate, sharp psychological pain of the error of commission, what does the investor do?
They do nothing.
Inaction. They stay on the sidelines waiting for absolute certainty, which of course never comes.
So avoiding that first quick loss becomes the absolute psychological priority, even if it means missing a potentially huge life-changing upside.
Right.
But then the price starts to move up, the trend confirms, and that initial inaction leads directly into the next phase, the fermentation period. And this is where we see inaction inertia.
Inaction inertia is the psychological trap that just locks you in place. The investor now refuses to buy at the slightly higher price, let's call it pedo, because doing so would explicitly confirm and cement the feeling of having missed the low anchor price, P.
They'd be admitting to themselves, I failed, I should have acted, and I didn't.
Precisely. They are paralyzed because a purchase now validates their earlier mistake. It's like a self-flagellating purchase.
So they're just hoping for a miracle.
They hold on to the illogical hope that the price will magically pull back to that PO or maybe even lower, which would justify their initial hesitation. It would make the eventual purchase feel less like an acknowledgement of a past error. But, the market rarely accommodates our emotional accounting.
It doesn't care about your feelings.
It doesn't. They are paralyzed by their own internal retroactive auditing.
And this paralysis just builds and builds until we hit the peak trend, the outbreak period. This is where the emotional circuit breaker finally just blows out.
The momentum shifts because the accumulated pain of the other regret, the error of omission, finally and often violently exceeds the initial fear of commission regret.
The fear of missing out.
The omission pain. It's the feeling of missing out on the opportunity. And it's compounded by social pressure. They are constantly reminded by their friends, by social media, by news headlines that other people are getting rich.
And that social comparison triggers intense FOMO.
It does. It makes not making money feel objectively and often socially worse than losing money.
So the fear of losing money is totally replaced by the sheer agony of watching everyone else win.
Exactly. The pressure becomes unbearable. That survey confirmed this really high desire among respondents to create and join trading chat groups. It shows how crucial that social reinforcement is in driving this final impulsive action.
And the behavioral outcome is the predictable climax.
Impulsive buying. Full position, impulsive buying at the riskiest, highest point, driven purely by the desperation to alleviate that social and internal anxiety and just catch up immediately.
It's the definition of self-sabotage. But the problem doesn't even end when the position is opened. It extends into the exit strategy, or more accurately, the complete lack of one when the market inevitably turns.
The exit dilemma, stop-loss paralysis. This is where the discipline truly breaks down for good.
And the numbers back this up.
They do. The failure to execute a stop-loss order was cited as the primary cause of losses by 42.7% of the respondents. That is significantly more than those who blamed a simple lack of skill, which was only 8.4%.
That's a crucial distinction. It means investors know the principle of cutting your losses. They know they should do it.
But they are psychologically blocked from actually executing it.
So why can't we hit that sell button on a loser? Why is a paper loss so much easier to hold than a real one?
There's a neuroeconomic reason for this paralysis that involves, well, literal physical pain. Neuroimaging research shows that the moment you execute a sale on a losing stock, the moment you make that loss real and irreversible, It activates the brain's pain center, specifically the anterior insula.
And that's the same region that reacts to physical pain.
Like a burning sensation, yes.
So selling a loser causes a literal neural pain signal.
It does, but if you keep the position open, it's just a paper loss. It's an accounting possibility. It's not real yet.
By holding the stock, you avoid that immediate, irreversible psychological pain.
And critically, you protect your ego from having to admit that the previous FOMO-driven decision, that impulse buy at the peak, was a mistake.
So keeping the loser is less painful psychologically than admitting the error, even if logically holding it is financially devastating.
Precisely. To avoid the certain immediate pain of a stop loss, investors default to being risk-seeking. They hold the losers in the hope of an improbable rebound. They go from being risk-averse in that latent period to risk-seeking in the panic period.
And that's the core manifestation of the disposition effect, selling winners too early and holding losers way too long.
It is a powerful, primal psychological defense mechanism against regret.
And this individual predictable psychology then scales up to create the macro context of the bubble that we see in the headlines. This is the bedrock of the greater fool theory.
The greater fool theory just formalizes this collective madness. It suggests that assets are bought not based on any intrinsic valuation or projected future cash flows,
but solely on the expectation that you can sell it to an even greater fool at a higher price tomorrow.
Right, and that expectation sustains the speculative run far past any rational justification.
And the ubiquity of that 97% FOMO cycle ensures the supply of these fools is virtually guaranteed until the music stops.
Until the supply runs out. The economist Burton Malkiel once likened it to a Ponzi scheme where increasingly credulous investors must be found to buy the asset from the earlier investors.
And once that demand evaporates,
the price crashes back toward fair value, which, for a pure speculative asset, could indeed be zero. This collective irrationality is the micro-foundation of market overshoot.
It's clear that the human weakness is highly consistent, which means the solution can't rely on just better personal control.
No, it has to be systematic. It has to be rules-based discipline to override this emotional circuit.
Okay, so that deep dive into individual behavior shows that our psychology is just rigged to fail in a fast-moving, high-momentum market.
It is.
Now let's turn to the big picture and ask if this psychological engine is currently driving a bubble the size of the dot-com era.
The big question.
Right. Given the massive hype around AI, everyone is asking if we're living through dot-com 2.0. But instead of just looking at stock charts, what if we use the objective history of scientific activity, the very engine that fuels these technological revolutions, to predict the financial hype?
This is a really powerful research application. Can data-driven analysis on scientific publications predict future financial disruptions by looking at historical patterns from the dot-com era?
What's the core hypothesis there?
The core hypothesis is that as a technology moves from true innovation to speculative hype, the underlying pattern of scientific effort has to change in measurable ways.
So the way scientists collaborate, cite each other, publish, that should tell a story about whether a field is reaching genuine maturity or just, noise-filled speculation.
Exactly.
To frame this, we often talk about the Gartner Hype Cycle, which offers a simple way to visualize a technology's journey.
Yes, the classic 5-phase framework. Technology trigger, peak of inflated expectations, trough of disillusionment, slope of enlightenment, and finally the plateau of productivity. It suggests a very tidy cyclical path.
But this research reminds us that the model is pretty unreliable in practice. We should be cautious about relying on it.
Absolutely. The analysis shows the full cycle is a rarity. They estimate that 60% of technologies that fall into that trough of disillusionment never actually recover to hit the plateau of productivity.
They just fade away.
They just fade away. So while it's a useful concept, we need hard data on the scientific production ecosystem to see if it exhibits predictable bubble signals.
Okay, so let's look at the first piece of evidence. Scientific publication network structure. So researchers analyze citation networks, treating authors as nodes and citations as edges,
Right.
to measure network characteristics like density, collaboration rates, and how groups of researchers, these clusters, were organized.
Yeah.
They compare the dot-com era from 94 to 01 to the AI era from 2017 to 2024.
And the patterns are strikingly, dramatically different. This is our first major clue that this is not a simple repeat of the 1990s.
So what did they see in the dot-com era?
In the dot-com era, we observe fragmentation. It was almost a scientific free-for-all.
How did that fragmentation show up in the network data? I mean, let's put this in lay terms.
Okay, so imagine the flow of knowledge as an intricate highway system. During the dot-com boom, the scientific effort just splintered. The clusters, so, groups of closely connected researchers working on similar topics, they became smaller, more numerous, and more equally sized.
A lot of little research shops popping up everywhere.
Exactly. This fragmentation was reflected in a decreasing Gini coefficient, which measures inequality in cluster size.
So the research communities were small, numerous, decentralized.
Right. And crucially, the overall network became denser. That means the average path length, the number of steps needed for knowledge to travel from one author to another, it decreased.
So information spread incredibly quickly.
But direct collaborations were declining. This suggests indirect short-term partnerships. It was a dense, decentralized, rapidly spreading but highly fragmented research environment, a chaotic sprint for novelty.
That sounds like a boom and bust cycle waiting to happen. Information spreads quickly, but without deep, sustained collaboration, the foundational knowledge base might be pretty thin.
That's a good way to think about it.
Okay, so now what happened in the AI era?
The AI era showed almost the exact opposite structure. We can call it segmentation and consolidation. The average cluster size and the number of clusters both increased strongly, so an explosion of activity. But here's the key divergence. The network density decreased and the path length increased.
Wait, hold on. If there are more authors and more clusters, why does knowledge take longer to spread? That seems really counterintuitive in the age of the internet.
It's the segmentation that kills the efficiency. While direct collaborations increased sharply, which makes sense given the massive computational complexity of modern AI requiring large teams, the inequality in cluster size remained consistently high.
So you have some massive, dominant, well-funded clusters.
And then many smaller ones operating on the periphery. This creates these informational echo chambers.
So we have highly concentrated knowledge flow within those dominant groups, but slow, inefficient flow between them. The knowledge highway is clogged at the intersections.
Precisely. The scientific publication network is becoming highly segmented, meaning ideas and fundamental knowledge flow slowly and inefficiently across those critical network boundaries.
And the conclusion here is?
The conclusion here is definitive. AI publishing activity, with its consolidation and longer path lengths, does not resemble the chaotic dot-com fragmentation. Relying on 1990s scientific indicators to forecast an AI burst is just irrelevant.
That's a powerful rejection of the whole dot-com 2.0 analogy. But the researchers didn't stop there. They dove deeper using some pretty advanced analytical techniques to look at author influence patterns.
Yeah, specifically the authors who played a critical bridge role between research communities. They used techniques typically reserved for classifying complex networks to compare the structural roles of authors in the two eras.
And what was the overall finding?
The influence patterns were fundamentally different. Statistically, the comparison yielded a similarity value near zero, confirming that the average behavior and influence structure are completely incomparable.
But didn't they find a small, subtle signal of hype within the AI data?
They did. This is where we shift from the macro structure to micro behavior. A small subset of AI scientists, specifically 1,964 authors out of a massive sample of nearly 300,000, they exhibited influence patterns that closely resembled those highly influential bridge scientists active during the dot-com boom.
The people helping knowledge jump across fields.
Exactly. Now, this could be an early indicator of localized hype or speculative behavior permeating research, but on its own, it remains pretty inconclusive for forecasting a crash.
Okay, so the micro signal exists, but the macro structure is stable and fundamentally different. Now let's move to evidence 3, financial market phase classification.
Right.
Here, researchers decided to train advanced predictive models on the actual financial data of the dot-com era, labeled as pre-bubble, hype, and burst phases, and see what it said about the current AI market.
The model used volatility and IPO data, which are typically very sensitive indicators of investor sentiment. So what did it predict for AI?
And the answer was?
The model did not confirm an obvious growing AI bubble, which, again, suggests the market dynamics are behaving differently. It appropriately classified phases for volatility and IPO data, so it could track sentiment. But the results, when applied to the AI era, were highly ambiguous.
We saw an anomaly and a phase mismatch. Tell us about that.
The ambiguity is the real story here. Between 2020 and 2021, the market crossed what the researchers termed an anomaly threshold.
Meaning
The financial behavior observed was structurally unseen in the dot-com era. The model detected a new, unprecedented pattern woven into the market. Yet at the same time, it classified this period as a dot-com hype buildup phase.
So the market was behaving like hype, but with an entirely new, unmappable characteristic. That's fascinating. The model is saying, this looks like a buildup phase, but the underlying mechanics are completely unfamiliar.
Exactly. And then in 2023, the model threw its hands up completely. It classified a period as a bubble burst, despite no real-world collapse occurring.
Which suggests a massive failure of pattern matching. The model was relying on 1990s indicators that are just no longer relevant.
It seems so.
Doesn't that fundamentally invalidate our ability to forecast any tech bubble using historical financial data from past cycles? I mean, if the market crossed an anomaly threshold, we are truly in unprecedented territory.
That is the essential implication. The interpretation has to be that the AI phenomenon is either structurally unprecedented, the market has learned lessons from the 90s and is now expressing speculation in a new unmappable form, or that the concept of a cyclical bubble, as defined by the 1990s model, is simply non-existent this time around.
The game has changed.
Financial markets have evolved significantly. Global liquidity, central bank policies, the spread of information, it's all fundamentally different.
Okay, let's discuss the final and perhaps most surprising piece of evidence. The relationship between scientific activity and market volatility.
Right.
Using statistical models, researchers tested if changes in scientific publishing collaborations, network density predicted future market returns, and volatility.
In the dot-com era, the link was surprisingly weak. Only the CBOE VIX, the volatility index, a measure of fear, was significantly influenced by scientific collaboration levels.
But not the major indices.
No, the major indices, NYSE, NASDAQ, S&P 500, showed little to no influence from publication patterns. Scientific breakthroughs, the core innovation, were largely decoupled from the broader market's value perception. Volatility spikes were strong, but they were short-lived.
So in the 90s, the lab was largely separated from Wall Street, except maybe for these brief emotional spikes in fear. What about the AI era?
This is the crucial finding, and it's one that speaks directly to the increasing integration of technology into the economy. In the AI era, NYSE, NASDAQ, and the S&P 500 all showed a significant positive correlation with scientific publishing activity.
So as collaborations, path length, and network density increased in the scientific world.
The volatility of the major stock indices increased.
Wow. The stock market is now more impacted by the publishing behavior of scientists than it was 30 years ago. That suggests investors are paying much closer attention to fundamental research.
It implies a profound shift. Investors today are tracking and reacting to scientific progress, even its internal structural changes and rate of collaboration, more closely and systemically than they did in the late 90s. The market is listening to the lab in real time.
At the same time, the data shows that even though volatility has increased,
volatility shocks have less lasting impact on future returns compared to the dot-com era.
meaning investors are more tolerant of market swings. Perhaps that widespread information availability we discussed earlier has provided a kind of resilience.
It could be. The market reacts with increased volatility to the news of scientific progress, but that volatility doesn't lead to the same duration of lasting negative impact. It suggests a more mature, maybe more informationally efficient market structure, even if it is a more reactive one.
So, to synthesize part 2, we cannot confidently predict an AI bubble burst using dot-com patterns because the underlying scientific and financial structures are just structurally different. The market has crossed an anomaly threshold.
Right. But the data confirms that scientific research is now a far more integrated and therefore volatile input into the modern financial market structure. The market is listening, and when the lab speaks, Wall Street reacts.
The entire discussion, so far from the psychological traps of buying high to this new tight correlation between scientific papers and market volatility, it all pushes us toward the question of value.
Exactly.
Why are valuations for these massive tech companies so high, and why do traditional methods fail so spectacularly to justify them?
We're facing a core crisis for traditional value investing. The classic philosophy, established by Benjamin Graham decades ago, relies so heavily on static quantitative analysis metrics like price to earnings, price to book, price to sales, and this principle of the margin of safety.
And that worked perfectly well in the industrial age.
It did, when a company's value resided in tangible assets, factories, inventory, machinery, real estate, things you could touch and count.
But the problem now is that these traditional backward-looking metrics completely fail to capture the nonlinear dynamics of technological value creation in the digital age.
which leads to massive and systematic undervaluation of modern tech firms by traditional analysts.
I mean, just look at the sheer failure of traditional indicators when you apply them to today's giants. The classic example is Amazon in its explosive growth years.
During its massive expansion phase, Amazon invested every single penny of potential profit back into infrastructure logistics networks, fulfillment centers, and critically the development of AWS cloud services.
Right. And these enormous strategic investments resulted in low reported profits or even outright losses year after year.
So the PE ratio, which measures current profitability against share price, was either negative or just ridiculously high. It was screaming overvalued or failing.
But the real value was in the infrastructure being built underground, so to speak.
Exactly. To a traditional value investor using a static model, Amazon looked like a catastrophic investment. They missed the true value, which was in its aggressive exponential growth trajectory. For example, AWS revenue grew an astonishing 271% just between 2016 and 2020.
And that trajectory, that massive reinvestment into future dominance, is completely invisible to a metric that only looks at current profits versus book value.
Right, or consider Netflix. Their content creation costs are massive.
And those huge costs for original content lead to relatively low gross profit margins, which again looks bad on a traditional income statement.
Yet this analysis completely fails to capture the long-term compounding brand equity, the irreplaceable content library, and most importantly, the subscriber network value. The sheer cost of switching platforms for a loyal subscriber base justifies a far higher valuation than a static PB ratio ever could.
This issue really boils down to the absence of measurement for intangible assets. Our accounting system is still anchored in the 1970s.
The gap is now a canyon. Since the 1970s, the economy has fundamentally changed, but accounting standards haven't kept pace. Today, intangible assets, things like R&D, proprietary algorithms, massive data sets, customer relationships, brand equity, they represent approximately 90% of the total market value of S&P 500 companies.
90%. So 90% of the value of the most important corporations in the world is simply not tracked or quantified accurately by the traditional balance sheet.
And that's because accounting standards generally require R&D to be expensed. Think about that. The same system that treats the purchase of a paperclip as a cost of business treats a multi-million-dollar, multi-year AI algorithm development project, the core asset of a company, as an immediate sunk cost.
It's immediately taken off the books.
Completely failing to capture the core value asset the company has created.
Let's talk about that intangible value mode. Google is the ultimate example of algorithmic dominance.
Google's stock growth is based on something that doesn't physically exist in a measurable traditional sense. Its value isn't driven by how many physical servers it owns.
It's driven by its algorithmic moat.
Its proprietary search algorithm and its dominant, nearly monopolistic market share, which globally exceeded 92% in 2023. This is a strategic resource that is almost impossible to replicate, yet its value doesn't sit neatly on a balance sheet.
No traditional model could possibly predict the trajectory of a stock that went from $85 at IPO to over $700 based on something as abstract as a search algorithm.
And Apple shows us the power of ecosystem synergy.
Right.
The immense value of Apple isn't the cost of the aluminum casing on an iPhone. It lies in its integrated ecosystem. The synergy between the hardware, the proprietary OS, the services like the App Store, and the massive cloud backend. This forms a self-reinforcing network effect.
And the customer base generates enormous network value.
Absolutely. U.S. users alone were spending around $100 per capita on the App Store back in 2019. This synergy and massive brand value are fundamentally invisible to PB ratios.
So if the assets are invisible, what about the competitive defense mechanisms, the moats that Warren Buffett loves? These are eroding faster than ever.
The traditional static moat theory, which assumes durable, long-term competitive advantages, is breaking down because those advantages erode at the speed of software development.
And the numbers are pretty stark.
They are. The average lifespan of S&P 500 companies has dropped dramatically from 60 years in the 1960s to less than 20 years today. The speed of technological disruption is making sustained dominance nearly impossible.
This speed creates the paradox of path dependence, where clinging to past success leads directly to catastrophic failure.
The comparison between Kodak and TSMC is textbook. Kodak, which practically invented the digital camera, failed catastrophically because of its over-reliance on its legacy film technology. It suffered from path dependence. It could not abandon its successful past to embrace an uncertain future.
And in stark contrast.
You have TSMC, a chip manufacturer, successfully navigating these hugely complex technological shifts, constantly reinvesting and adopting new technologies like heterogeneous computing. This agility allowed its market cap to surge ahead of even Intel, which was slower to adapt its core technology structure.
And this erosion is accelerated by what the sources call cross-border attacks, where innovation blurs traditional industry lines and destroys assumed competitive barriers.
Amazon's acquisition of Whole Foods is the definitive example of a cross-border attack. It wasn't just a retail deal.
No.
It integrated e-commerce capabilities with physical logistics and supply chain efficiency, fundamentally attacking traditional grocery retailers on multiple fronts simultaneously.
And traditional valuation models, which only looked at retail sector metrics or food brand equity, couldn't predict that.
They couldn't predict or quantify the catastrophic risk posed by this cross-domain integration, and it led to significant stock price declines for traditional competitors like Kroger and Walmart almost overnight.
So we have a system where our measuring stick traditional accounting is only capturing 10% of a company's real value, and the moats defending that value are evaporating every year. The old framework is broken.
Completely.
What are the actionable takeaways for building a new framework capable of valuing the digital age?
The solution requires innovation in 3 key directions that directly address the systematic limitations we've just outlined.
Okay, number 1, we need a critical shift from static to dynamic analysis.
This means abandoning the reliance on stale quarterly reports and leveraging big data analytics and the computational power of AI to monitor financial metrics, KPIs, and user engagement data in real time. The valuation should be a fluid model that updates constantly, not a calculation you do once a quarter.
Second, and this feels like the most important shift, from tangible to intangible assets.
Yes, we have to focus on methodologies to measure and value the true drivers of modern growth. This includes attempting to put a financial number on proprietary algorithms, massive data assets, network effects.
Like subscriber counts or developer community size?
Exactly. And brand equity. Metrics like daily active users or DAU or customer lifetime value are now fundamentally more informative for technology firms than traditional book value.
And finally, moving from single-dimensional to multidimensional assessment.
We have to move beyond simple ratios like PE. A robust model has to incorporate a broader range of forward-looking and dynamic risk factors, including non-financial risks like environmental, social, and governance factors, integrating them into complex, AI-driven models.
So the goal is a holistic system that can handle the speed, complexity, and interconnected risks of the modern global economy.
Something a human spreadsheet analyst simply cannot compute alone.
Okay, we've established that investor psychology drives failure, scientific activity drives volatility, and valuation models drive confusion.
Right.
Now, let's wrap this up by looking at the scientific infrastructure that fuels this entire process. Because according to the framework established by the economist Carlota Perez, we are currently deep into the 5th major technological revolution, the age of information and telecommunications, which began roughly around 1971 with the invention of the microprocessor.
Perez's model is so critical because it contextualizes today's boom. These technological revolutions follow coupled financial cycles. We are likely past the initial eruption phase and deep in what she calls the frenzy phase,
which is characterized by increased speculation and financialization.
the very environment that magnifies the psychological traps we discussed in part 1.
Yeah.
This is where financial capital, or speculation, decouples from production capital, the real economy, leading to the inflation of those massive asset bubbles.
And if part 2 showed us that scientific activity is now highly correlated with market volatility, then the health and quality control of the scientific community itself becomes a primary concern for financial stability.
Absolutely. If the source of innovation is unstable, the market built on that innovation will also be unstable. And this brings us to the crisis in scientific publishing.
The fundamental problem is volume.
It is. The rapid exponential growth in publications, fueled by technology and the ease of digital sharing, is just overwhelming the entire system. This boom is creating increasing noise in the citation networks.
Meaning low quality, rushed, or incremental research dilutes the truly breakthrough findings.
Right. And the surge is also undermining the utility of traditional metrics like the journal impact factor, which may become artificially inflated due purely to the sheer volume of output rather than the quality of the discovery.
And that noise makes it exponentially harder for investors, corporations, and even the predictive models we analyzed earlier to distinguish genuine scientific advancement from mere hype.
It obscures the signal, making financial bubbles more likely. But the real structural problem is the breakdown of the peer review system itself.
How does that work traditionally?
Well, scientific publication has historically operated as an informal, collaborative economy built on trust and professional obligation. Scientists submit papers for free, and there is a general unwritten understanding of professional honor code that they will return the favor by reviewing others' work, often spending days or weeks doing so.
And their careers depend on getting published and maintaining the integrity of this system.
They do. But this honor code has run into the modern pressure cooker, and it's resulted in the classic tragedy of the commons.
Explain that.
Well, the system is structurally prone to collapse. If we assume a typical paper acceptance rate and the need for 2 rigorous reviewers per paper, a publishing scientist should ideally be reviewing maybe 2 to 4 papers for every paper they publish annually. That's a massive time commitment.
But there is virtually no formal incentive to do this onerous quality control work.
And here's the problem. The institutions that determine career success don't value the quality control.
Right.
Universities typically do not factor peer reviewing into promotion or tenure decisions, and it certainly doesn't contribute to the scientist's personal impact factor metric, which is what often determines their prestige and funding.
So the system creates this perverse incentive.
Yeah.
Publish a lot to boost your career.
And review as little as possible to save time. This leads to a critical shortage of qualified reviewers, long delays, and a severe driving down of review quality. The system is stressed to the breaking point because its reliance on an informal honor code is fundamentally unsuited for the volume and speed of the digital age.
That analogy holds perfectly. Just as 20th century valuation metrics failed to value 21st century technology, the 20th century informal academic economy fails to handle the volume of digital publishing.
It's the same problem, different domain.
So, what's the proposal to fix this failing system and introduce the necessary guardrails to curb the noise that fuels financial hype?
The proposal centers on formalizing the scientific economy, moving it from a handshake agreement to a structured system.
How would that work?
It would involve instituting a token system, potentially using blockchain technology for verifiable decentralized tracking. Scientists would receive credits or tokens for conducting peer reviews tokens that represent measurable, valued contribution to quality control.
And then submitting a paper would require these tokens as payment or credit. It essentially creates a managed supply and demand curve for intellectual labor.
Exactly. Each submission would require a predetermined number of credits. This creates a formal, regulated economy designed to shift the focus from simple publication volume to rigorous, high-quality work and essential service.
How do you make that fair?
The sources suggest making the system fair by providing early-stage researchers with a starting pool of tokens and rating peer reviewers on the quality and depth of their critique to affect the value of the tokens they receive. This transforms a cost center reviewing into a valuable asset.
And the potential benefit of this, looping all the way back to our original problem in part 2,
is that such systemic guardrails would dramatically reduce noise in the system and ensure that citation networks more accurately reflect actual influence and merit rather than just inflated volume.
which in turn would directly help mitigate future financial bubble risks.
It would. By reducing the noise and improving the signal-to-noise ratio in those early detection models of scientific hype, like the ones that struggled to classify the AI boom, investors, regulators, and policymakers would have a much clearer view of where real, fundamental innovation is occurring versus where the speculation is merely following an inflated volume of mediocre research.
It's an economic solution to a quality control problem.
It is.
This has been a fascinating and highly technical deep dive through the market, the emotional wiring of the human mind, and the scientific apparatus that feeds the entire system.
It's a lot to connect.
It is. Let's synthesize the 3 key surprising takeaways for you, the listener.
Okay, first, on the bubble front. We cannot confidently predict the AI bubble using dot-com patterns, period. The fundamental market and scientific dynamics are structurally different, crossing an unprecedented anomaly threshold.
Look what the big insight is.
The data confirms that scientific research is more correlated with market volatility today, meaning the link between the lab and the stock exchange has never been tighter. Scientific papers now move markets.
Second, on behavioral finance. Your actual investment success or failure is largely decided not by your skill in picking stocks, but by your ability to manage the double regret trap.
That's right. That is the fear of commission leading to paralysis and hesitation during the low-risk entry phase, followed by the fear of omission leading to chasing the price at the high-risk peak.
And this trap is near universal.
It is. And third, on valuation. The traditional financial world's valuation tools, PB, are failing spectacularly because they cannot quantify the value of intangible assets, network effects, or the sheer speed of modern technological disruption.
The assets are invisible, and the competitive moats are shrinking faster than ever before.
The only viable path forward is dynamic, multidimensional, AI-driven analysis.
So the final actionable advice for you to implement today is simple, but it's often brutally difficult to execute. The bottleneck in retail trading isn't prediction skill, it's discipline.
That's it.
You have to use pre-commitment mechanisms. That means using conditional orders or hard stop-loss orders to set clear entry and exit rules when you are in a cool, rational state.
This is the only reliable way to remove emotional interference when the market inevitably puts you into that hot state of greed and fear.
Stop chasing predicted tops and bottoms and focus ruthlessly on automating your execution based on predefined criteria.
And here is a final provocative thought for you to consider. The analysis suggests that both the financial markets and the scientific community are fundamentally struggling because their old structures, traditional valuation metrics, and the informal peer review economy are profoundly unsuited for the speed and scale of the digital age.
So this raises the question, what other foundational pillars of our economy and society are still operating on 20th century logic, relying on static rules and informal trust?
Think about the existing limitations that were noted. The ambiguity surrounding digital property rights, the opacity of algorithmic black boxes driving economic decisions, or fragmented global regulatory policies. How exposed are we when the next, even faster technological revolution hits an entire system built on outdated frameworks?
The need for systemic adaptation goes far beyond just your portfolio.
It touches the very foundation of how we define truth, value, and stability.